Most beginners obsess over entries. Where do I buy or where do I sell? But entries don't keep you in the game. Risk management does. If you can't manage risk, it doesn't matter how good your strategy looks, you'll blow up. Think about pilots. Takeoff isn't the danger. It's when the engine fails or a storm hits. That's when training decides who lives. Trading is the same. You're not judged by your best winners. You're judged whether or not you're still in the cockpit after the losers. Rule number 1. Never risk more than a fixed percentage of your account on a single trade. 0.5%, maybe 1%. On a $10,000 account, that means risking $100 max. It feels small, but stretched across 100 trades, you're still standing. Risk 10% on one position, and you might not even last a week. The more you risk, the faster it can disappear. And remember, this is crypto. Unlike stocks, there's no closing bell at 4 p.m. The market runs 24/7. That means if you fall asleep oversized, you can wake up to a liquidation you never saw coming. This market doesn't forgive overnight mistakes. I learned that lesson the hard way during the Terra Luna crash. I'd been watching it for hours, convinced that this was the perfect setup, that Luna couldn't keep falling forever. I loaded up heavy, probably way heavier than my rules allowed, almost half my account. At first it looked fine, but then the selling accelerated and the price started to crater, and I froze. My stop was clear, but I didn't take it. I sat there watching thousands vanish. $7,500 gone in a matter of hours. The money hurt, but what crushed me was everything behind it. The hours wasted in overanalysis, the exhaustion of sitting there second guessing myself, and the realization that I hadn't lost in the market, I'd lost my own discipline. Worse, the aftermath lingered. The next few trades I hesitated. I second guessed entries. Then I swung the other way, forcing trades to make it back. That one mistake poisoned my mindset, and it set me back weeks of progress. That's when it finally clicked. Professionals don't obsess over this trade. They're playing for the next 100. Here's the math that proves it. You don't need a 70% win rate. If you risk $100 to make 300, you can lose 6 trades in a row and still come out ahead. 6 losses, minus 600, 4 wins, plus 1,200. Net profit, plus 600. That's why pros focus on risk to reward, not win rate. It's not just retail traders who blow up. In 2021, Archegos Capital collapsed, a multi-billion-dollar hedge fund, gone in days. Why? No risk control, too much exposure, and no plan to cut losses. When the market turned, $20 billion evaporated. If it can happen to a hedge fund, it can happen to anyone. And in crypto, we saw the same thing with Luna. Billions wiped out in days. Not because people were wrong once, but because they had no stop, no plan. That disaster didn't just hurt portfolios. It erased life savings. It wiped out entire communities. Risk management wasn't optional there. It was survival. Here's the boring math that keeps you alive. Position sizing. First, decide your risk, say $100. Now look at your stop. If your stop is $50 away, that means you can only take 2 contracts. Think of it like poker chips. Your account is a stack. Every trade is you putting chips on the table. The farther your stop is from entry, the more chips you're risking. So the rule is simple. Only put enough chips down to match the risk you already set. That way, no single hand, no single trade can wipe you out. If you want to dive deeper into risk management, we've put together a complete breakdown on our website. I'll put a link in the description below. Here's the reality. Losses are part of the business. They're not personal. They're expenses. Think about it like running a restaurant. You don't shut down a restaurant because you paid rent or because you bought ingredients that didn't sell. Those are overhead. They're the cost of doing business. Trading is no different. Your losses are operating costs. The only question is, are your wins covering those costs and leaving profit? The moment you start thinking like that, you stop trading emotionally and you start trading professionally. So here's the takeaway. Stop chasing perfect entries. Start mastering what most traders ignore. Fixed risk per trade, proper position sizing, and respect your stops. In crypto, where the market runs 24/7 and liquidations can hit while you're asleep, this isn't optional. This is the line between blowing up and building a career. Because the traders who last, they're not the ones with the prettiest charts. They're the ones who manage risks.